Hi, and welcome to Macro Monday, where we talk macro and try to make sense of markets that really don't make any sense. I'm your host, Steven Van Metre. We're in full crown mode today, and that's not because bond prices are up 2 days in a row and I'm gloating. No, it has nothing to do with that. All right, today, what do we have on deck for you? Senior Loan Officer Survey for the third quarter. I've been wanting to talk about this. I've really been meaning to. You remember, I think my most popular show is on how banks are going to crash the market. Yeah, well, let's look at the third quarter data and give you some very convincing evidence that banks are going to crash the market. I want to look at today's economic data, particularly the Chicago Fed National Activity Index. I want to talk about how hedge funds are positioned, why banks are long. Many of you had this question, are banks hedging? Is that what they're doing? What's going on? I want to answer that. The dollar. I've been meaning to talk about the dollar. I know some of you said, well, talk about the dollar. Dollar. Today, dollar day. I've got stuff on the tabs. We're ready to do that. And how can we not talk about VIX? It's getting very interesting. Lots of interesting things now starting to happen. And we need to look at them. Let's start with the economic data. Not a lot. We'll come back to the Chicago Fed here in a second. New home sales. Disappointed expectations dropped 3.5%. in September. Now, usually home sales slow down into the winter months, so this is not exactly what you wanted to see in the housing market, considering just how much demand there's been. But what's interesting is the Chicago Fed National Activity Index, which dropped from just a blistering high 1.11, which is completely abnormal for this index, down to 0.27. And so how do we find that? Well, we can go to the Federal Reserve Bank of Chicago. You can pull up the National Fed Activity Index, and we can look at the current data. And you can see the historicals are very, very skewed. Now, what's nice about the Chicago Fed National Activity Index is they've got a lot of data on it. And what it tells you is when the index is over zero, which it's right now at 0.27. So, or when it's zero, it means that economy is growing pretty much at trend. Now, when it's over zero, that is a positive thing. When it's below zero, it's negative. Now, however, the index is pretty noisy. And so let's zoom this in a bit. And I want to show you why this 0.27 is not necessarily a bad thing. It's not necessarily a great thing. It's good. But you can see how noisy the index is. And it can bounce in between, 0 to 0.27, minus 0.23, it bounces all over the place. And so even the Chicago Fed says, look, you can't look at this month to month. And when we bring in the recent data here, you can see something very, very important, and that is it's decelerating here, which would make sense that it's going to decelerate back to that trend of zero, but it's getting there very quickly. So again, even the Chicago Fed says, look, you probably shouldn't focus on the month-to-month value. So we have a 3-month moving average. And that says that if the 3-month moving average is above 0.7, more than 2 years into an economic expansion, that has been associated with increasing inflation. So we need to see 2 years of this value over 0.7. So that's pretty interesting. Let's take a look at where the 3-month moving average in relation to inflation cycles are, and it's decelerating rapidly. So it's telling you that, well, if you were worried about inflation, and I know many people are, that this index is telling you not so much. And they do run it against the business cycle, and you can see the same trend. It's the same chart. It's headed lower. So this is telling us that from a inflation standpoint, there's nothing really to worry about. And then from the business cycle, let's see what it says here. The increasing likelihood of recession when the 3-month moving average falls below minus 0.7. And it is currently at, if I can get the mouse to hold over that, 1.33. So no risk of a recession from this, although arguably we're still in one. And, an expansion has been historically with this moving average above 0.2, but it's been skewed by the shutdown and skewed by the brief reflation. So keep that in mind, but it's decelerating. And what we want to see, if you want to see that, hey, this isn't an economic expansion, you want to see this thing start to bottom out real fast. If it continues to trend down and break below the zero bound, that is not positive for a reflating economy. All right, let's talk about the banks. So one thing that is important to understand is this, something called a Senior Loan Officer Opinion Survey, or SLOOS, S-L-O-O-S. And this is something that we looked at quarter 2 because it gave us this really nice chart of the mortgage market. And in quarter 3, I think we may have talked about it. The charts weren't even worth looking at because they kind of changed every quarter depending on whatever the Fed wants to highlight in the charts. And I wish they'd highlight the same ones because for whatever reason, they have more data that they track than they actually put in their own Federal Reserve database for us to follow. And I find that kind of annoying, but it's what we have to work with. So what I did this morning is I pulled all of the data on all the tightening standards. So when banks tighten standards, what does that mean? It means they don't want to lend, or they're limiting who they're lending to. That is normally not a good sign. What you want to see when there is inflation or money printing or all these things that everyone thinks that are happening is if money was piling up at the banks and the banks were afraid of inflation, they would lower lending standards to get that money out the door. That's what they would do. So when you see tightening lending standards, it is not inflationary at all. So let's take a look at what happens to the stock market, the dollar, interest rates, and volatility, and why I said before the banks are going to crash the markets. Now, keep in mind, after Q2, I had a number of people who work in the lending industry email me and say, yeah, hey, you're right. Lending standards got tight. Don't worry, they're going to loosen. They didn't. They actually got worse in Q3. Now, I haven't heard back from anybody, nor have I gone soliciting for advice, but I imagine we'll hear the same thing now is, hey, they're going to loosen standards. Now, I want you to think about this. So macro is a lot about objectively looking at the big picture. And what's going on in the big picture? There are 23 million people unemployed. We're heading into fall and winter, which are traditionally slower times of the economy. We will now most likely not have any stimulus till February, and those stimulus checks kind of kept the economy going. So there's a lot of businesses that make quite a bit of money in the summer months to tide them through the winter months. Without that additional revenue, likeliness of more businesses closing, more rising unemployment over the next several months is likely. What about loans coming out of forbearance? That is going to happen. More loans are going to come out in November. And then, of course, December is a big month because, as many of you pointed out, hey, that's when those student loans all come back. And then what about the 12-month mortgage forbearance? Well, that starts to come out as early as March of next year. So there's a lot of red flags coming. What about the pandemic? Are case counts rising or falling? Well, if you haven't been paying attention, well, they're going this way, unfortunately. So we're starting to see record numbers. This is not going to be good for Europe, not going to be good for the United States. This is a problem. So think about it from the bank's perspective. If you were a bank, would you want to go lend to people right now? Yeah, I bet you wouldn't. So now let's go look at what's going on in the data and see if we can kind of conclude what is likely to happen. Because, what are we hearing people say? Oh, there's going to be a melt up in stocks. Or interest rates are going up. Wait till you see this. This is really powerful data. All right, so what we have here is a net percentage of domestic banks tightening standards for commercial industrial loans to large and mid firms, not to mention, and small firms, and then consumer credit card loans. Now, there are 3 other things we could have put on here, but they don't run, the data runs back only to like 2010 at best. So there's really nothing about that data that skews any of this. So I took it off just so you wouldn't get overwhelmed with too many lines on these charts. Now, in black is the Wilshire 5000. Again, the reason why we're not using the S&P 500 here is simply because the Fred database cuts the S&P off somewhere right around the Great Financial Crisis. So to go back any further, you've got to use the Wilshire 5000, which is supposed to encompass the entire U.S. stock market. And what do we see? When banks tighten lending standards, you've got several quarters here, stock prices start to go down. How about during the Great Financial Crisis? They tightened lending standards. Stock prices went down. When did stock prices start to rise? Well, when banks started to ease lending standards. How about in the dot-com bubble? Well, stocks actually didn't rise until well after the standards had eased. How about today? We are now at the second tightest lending standards in history. Everyone thinks we're at the cusp of a big bull market breakout. Statistically or historically, that is completely unlikely. What it tells us is the longer lending standards are up here and tight, the higher the probability is that stock prices will crash. Data's pretty clear about that. Let's go on and look at what happens to Treasury yields. Now remember, everyone thinks, and I know some of you don't agree when I say everyone. I say that tongue in cheek. What I mean by everyone is you look at how the market is positioned right now. The market believes the Treasury yields are going to rise. Now, not everyone watches this show and knows this stuff, so we'll forgive them. But look what happened during the dot-com bubble when they tightened lending standards. Interest rates went down as lending standards tightened. Then there was this, oh my God, reflation, and then yields crashed. Then they rebounded and crashed again. How about during the dot-com bubble? Yields again in purple, ode to Dr. Purple, if you don't know who he is. I did a show on him once, and he is fully in his Halloween costume, so he's ready to go for the weekend. Look what happened. Yields came down, oh my God, reflation, and then crash. What's happening now? Yields fall as lending standards rise, tighten. Yields have backed up, oh my God, reflation, and then what's going to happen next? Right. Going to crash because lending standards are staying tight. There's nothing that would tell us that in the first quarter they're going to ease, or this fourth quarter, or the first quarter of next year. There's just nothing that would tell us this is going to happen. And we're seeing this into H.8 data. Credit is contracting. How about the dollar? Remember, the common belief is the dollar is going to tank. It's going to, no one wants the dollar. We're going to have inflation. Yet, once again, when lending standards tighten, the dollar tends to rise, which makes sense because what is it telling us when lending standards tighten? It means the banks aren't issuing a lot of new loans. And how is new money created and brought into the system? Through lending. So that means the system, the monetary system has to work with the existing amount of dollars in there and then try to bounce that off if we're seeing a contraction where dollars are being destroyed. So what does that tell you about the dollar in that case? It has to go up. It's the only logical answer, and you see that right here in this chart. The dollar goes up, and so now everyone thinks the dollar is going down, and the most likely answer is no, the dollar is going to make a surge higher, just like it did back here. Well, again, lending standards tighten. Aha, dollar weak, and then boom, dollar went up. How about volatility? This is interesting. I overlaid volatility. And usually you see spikes in volatility occur when banks tighten lending standards. And look, here you have a great financial crisis. Banks tighten lending standards, volatility pop. Now, everyone, again, the same story is stocks are going to go up. So short volatility like crazy. Can't lose because the Fed's doing QE and that suppresses volatility, even though it does not. That's the market narrative. But what is it the lending standards telling you? Is there likely to be a big spike in volatility? And it's possible due to the pandemic, lending standards will get to their tightest level in history. This is entirely possible. And yet the market is completely discounting all of this. But I just want to let you know, or to show you the data, that the banks are really in charge of this picture. So when we start looking at, we'll look at how the futures market is positioned. We'll look at why, we're going to do the dollar first. I know many of you want to see the dollar, but I want you to be thinking of why would banks be taking a long position on bonds? Well, I'll tell you why. Because what happens when volatility spikes? The dollar rallies and stocks go down. Oh yeah. Interest rates go down. Remember, who's tightening lending standards? The banks are. They just happen to know there's going to be a huge demand for bond prices because they're going to create one. Isn't that interesting? I think so. I think it's very interesting. Let's go on to the dollar now. If we look at the chart of the dollar, we went over this on Sunday. We see, and again, when you see accumulation schematics, they're not going to be exactly like this illustration. They're going to be similar to it. So this is a Wyckoff accumulation pattern. Let's go look at the dollar chart. And on Sunday, I said that, look for this thing to oscillate up and down around its 50-day moving average before it takes off. And I've said toward the end of October is when this thing ought to get pretty darn close to blast off. Why is that? Because we've been sitting here for 90 days. And usually consolidation patterns in the dollar are around 90 days. Can they go longer? Sure. But I would look for next to move over the 50-day moving average. And if it starts to break through this 93.75 level on the trade weighted dollar DXY, tells me we're about to get liftoff. Now, why am I so interested in the dollar in relation to treasury yield? Because they work together. So here is a chart of the trade weighted dollar against 10-year treasury yields. And what do you see here? When the dollar rises, it puts downward pressure, big downward pressure on yields. Dollar rises, downward pressure on yields. Dollar rises, downward pressure on yields. Dollar rises, downward pressure on yields. Dollar rise, downward pressure on yields. You get me one more dollar rise in conjunction with the bank's tightening lending standards, I can tell you exactly why yields crashed right here and right here. You're going to get the same event. And no, I know the market is not expecting that. So that's what's interesting. When you go and look at how the market is positioned in the futures, what do we see in the 10-year note? Well, they backed off their longs a bit. I don't care about the 10-year that much. Look at the 30-year. All-time record for standard deviation event in the 30-year, meaning speculators are betting on what? Higher interest rates and lower bond prices. But what are the banks positioning for? Banks are thinking, hey, we're going to have big demand for bonds. We're going to need to get some bonds because we're going to create that demand internally. See, many of you were postulating that, hey, are the banks hedging? No. The banks know what the demand is. This is like being a retailer and you happen to know at a certain time there's going to be a huge surge in demand for certain products that you sell. So you go out and start buying it up, and everyone's like, man, what is he doing over there? Why is he buying all that inventory up? And he's never going to sell all that. And then all of a sudden there's a huge demand, and you clear out your inventory at a big profit. That's what the banks do. The difference is they're the ones that are creating it. They're going to create that demand by keeping lending standards tight. And what is their incentive? Yeah, well, their incentive is they're sitting on the opposite end of this trade. You know, these are speculative positions. These are hedge funds that are betting on higher rates, lower bond prices. The opposite, there has to be an equal and opposite end of this trade. And some of you have gone and looked. We've looked at the data. It's sitting on the commercial side. There's where your large banks are, your asset managers. Why are they taking the opposite end of the trade? They know demand's coming. Pretty cool, right? When you start seeing the big picture of this, it's pretty cool, isn't it? Let's take a look at West Texas Intermediate. Hedge funds increase their longs a little bit. Look, you get that rally in the dollar, all these hedge funds are going to have a whirl of hurt in their oil longs, especially if you looked at oil stocks today. Ouch. S&P 500 hedge funds increase their longs slightly. It's still long. I mean, this market is very long U.S. equities. How about the euro continues to slide? Everyone's super bullish on gold. They should watch the euro futures because as euro futures get backed off and down, that puts upward pressure on the dollar, downward pressure on gold. And speaking of gold, no real change in the long positions there as gold slowly goes down. Again, everyone's still, the view is 2,500, 4,000, 5,000 on gold. Dollar's telling you a different picture to that. They backed off slightly on the NASDAQ longs, nothing of interest there, and they went even longer on small caps. So again, bullish narrative here potentially on a stimulus package because what's important about the Russell 2000? It's pretty much all U.S. companies. So they're bullish, they know it's bullish move on perhaps stimulus package. Obviously, that's not happening. How about dollar index? They're still net short on that. Not a big change here from just a smidge long to net short. But remember, these are always been places where when speculators are short that you tend to see big surges in the dollar. Is that coming soon? I think it is. How about the volatility? Well, what do we see in vol today? Well, volatility sprang a leak. Speculators are still short. Let's go and look at the charts of volatility real quick. And I said, hey, when the VIX gets over 31, things start to get interesting. And it did. I was surprised it got over that today. When it gets over 36 is where the fireworks are going to begin. And you can see that it got up to about 33 today. And before I hit the record button, I found out that this was an excuse by speculators to short volatility. Again, they just can't get enough short vol positions here. The risk is, of course, with banks tightening lending standards, as you know, that volatility is going to creep higher. And if it breaks through this 36, then that makes the potential for a replay of March. Maybe something bigger, maybe not as big, but it's definitely a replay, potentially getting the VIX up to the 65, 70 level, which nobody in the market is positioned for. What is further interesting to me is Chris Cole of Artemis Capital posted this chart on Twitter today. And even though it says do not distribute, he posts on Twitter, so I'm not distributing, I'm just reviewing it. And what's notable to me is that the U.S. equity market is just shy of 40 trillion, and there's 20 trillion in the U.S. options market. Now, we can't assume that all of this is long equities, but what you're seeing is a problem is that people are renting this market with options. And when they buy options, dealers are forced to go buy the underlying security when you see the markets and it causes the market to rise. Now, when the market rolls over and heads lower, dealers start to sell. It's not because they want to, it's just because they're the way they hedge options and they sell. Imagine if some of this options started blowing apart and coming apart at the seams. And, again, we hear this whole view of, well, the equity market, right, can't go down. I mean, stocks are immune. They're never going to go down. They can't. Tech stocks are. I mean, this is it. For the first time in history, tech stocks will never go down. The market is solid. And I'll tell you what, you get an unwind in some of these where dealers are forced to sell, and then people are go running from their option contracts. Man, it could be painful. So just remember, the banks are in charge, and they want you to like and subscribe and tell all your friends about how cool this show is and why I'm weird and wear a crown. And with that, I'm Steve Van Metre. Thanks for watching. We'll see you on Wednesday, where I'm sure we'll have maybe some more exciting things to watch. I mean, look at the vol. I mean, watch the VIX. I mean, if we get some overnight moves down in the market, could be pretty exciting. I'll see you on Wednesday. Bye now. The content of this video is provided as educational information only, is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation by or sell a security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in the video that I don't know do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.